Did you know that you could sell a duplex in Cincinnati and go buy an oil well in Texas
No.
using 1031? Mineral rights, oil rights, and resources
Yeah.
for 1031. Now, what's beautiful about that? We have clients that ride the contra cycle. As real estate goes up, typically energy is cheap. As energy starts to rise, construction prices go up. Real estate start to do stagnated and retreat. So when real estate reaches that high, they will jump from highly appreciated real estate into less expensive oil and natural gas projects.
You're listening to the Accredited Investors Only podcast presented by Accredited Life.
All right, Dave, welcome to the show. How you feeling today?
Peter, it's an awesome day. We woke up and the sun is shining.
Hey.
What could be better?
Hey, I don't mind. The other day I woke up, it was kind of dreary and rainy, and I like a day like that as well every now and again, right?
I get about 5 of those here in Florida.
Yeah, exactly, right, exactly. I had a feeling because your shirt that you might be in Florida, so that's very nice. It's a little different than the Philly area here. So, but Dave, let's start with introduction. Yeah, so who are you? What are you doing? Why are you here? All that kind of stuff.
Dave Foster, and I was here because I wanted to meet the great Peter. Actually, just excited to talk to you and your folks today. I've made my mark in real estate. I am a serial real estate junkie, have been all my life. Never met a deal I didn't want to try to do. Probably did a few that I shouldn't have, but that's the learning curve, right? But along the way, I developed a niche in using for myself and then helping others to harness the power of the 1031 exchange in real estate development.
Nice. So, well, let's talk about that power. So, for somebody maybe that isn't clear what a 1031 exchange is, we'll start basic and then we'll build upon that. So, what is it? What's the power? That kind of thing.
Well, what's the oldest proverb in real estate investing? You make money. Well, there's location.
I was gonna say,
yeah. You make money when you buy.
Yeah.
Because we're all looking for the deals, right? That have the hidden equity that we're going to be able to tap. What I learned a long time ago from one of my mentors, they told me this: Dave, the measure of a person's wealth is not how much money you've made. It's how much money you were able to keep.
Definitely.
And Jimmy Buffett, I think, sang a song about that. He could have bought Miami, but he didn't keep enough. And so that kind of shaped my investing. And that's where the 1031 exchange really comes into play. Because what the 1031 exchange does, and by the way, it's a 100-year-old statute.
Wow.
It's just not that well known because the IRS doesn't advertise these things. You got to find them on your own. What it allows you to do is to sell investment real estate or real estate that you have highly depreciated and use the process and buy new real estate, and you get to indefinitely defer paying the tax. Indefinitely. Now, here's the power of that. We can talk about my very first transaction where I did not know this. And I bought a duplex in Denver, Colorado. I fixed it up. I put a renter in it. Later, I sold it. I thought I was fat and happy. Till my accountant said, you're going to stroke a $30,000 check this year. I said, no, that's not part of the plan.
Yeah.
He said, well, yeah, you've got a silent partner named Uncle Sam. Now, if I would have known about the 1031 at that moment, I would have been able to keep using that $30,000 for 35 years. And we know from amortizing and using the rule of 72 that if I was making 10% a year on that 30,000, 35 years later, I've got several $100,000.
Yeah.
That's from one transaction.
Yeah.
Over time. So the 1031 exchange allows you to harness that compounding effect of keeping your tax dollars for yourself.
Hmm. Interesting. Is depreciation recapture, does that come into play at all in the transaction?
Well,
Or?
absolutely, because depreciation recapture is like the greatest IRS scam of all time. They pretend
Explain what it is and how to avoid it, all that kind of stuff.
it's a situation where the government knocks on your door and says, "We're from the government. We're here to help." You just slam the door and run away. Now, depreciation is a pretend game
Mm.
where the IRS lets you pretend that your assets, and we're talking about real estate today, that your real estate loses money value every year.
Mhm.
You get to write that off on your taxes.
Mhm.
Well, that sounds kind of cool, doesn't it?
Yeah, yeah.
The same piece of real estate, I get to pretend it loses money, so I pay less taxes. Then the other shoe hits when you sell it.
Yeah.
And the IRS says, "Oh, by the way, that gift we gave you, you have to pay it back."
Yeah.
That's not cool. The 1031 exchange allows you to defer that
Mm.
as well.
Nice.
So if folks are like me and you've got a lot of them that are long-term buy and hold investors, they've got properties they've owned for 20 or 30 years that are depreciated out.
Sure.
The basis in those is zero.
Mm.
If you sell that, you got a huge tax hit, but you're also not getting any more depreciation
Yeah.
because it's done.
Yeah.
So I use the 1031 exchange then to sell that property and go buy, just for example, a property that's worth twice as much.
Mhm.
I'm deferring all the tax. I don't have to pay back the depreciation recapture, but that extra amount, if I sold the property for 500,000 and I'm buying for 1 million, that extra new $500,000 is new depreciation
Mm.
that I get to start harnessing,
Mhm.
which again lets me play that game of how much can I keep in my pocket at the end of the day.
Yeah. Interesting. Um, what are some of the things that investors need to know? You know what I mean? Like you'd mentioned, yeah, you might own a property for 20, 30 years. Yeah, and then 1031 into something else. Is there anything they should have on mind before maybe getting into that process or before they get into the sale process and all? Yeah.
Well, the first thing that you've got to understand is it's not a DIY. It's not something you do and then tell your accountant to report it.
Sure.
The IRS requires that you use the services of an unrelated third party called a qualified intermediary, someone like us.
Hmm.
And we document the exchange at the sale and at the purchase, and we hold your proceeds. The IRS does not let you touch the money.
Hmm.
Um, the along with that, then you have to understand the statutory order that your 1031 exchange starts with the sale of your old property.
Okay.
So your intermediary has to be in place. They have to be there before the sale of your property.
Mm.
Your exchange starts with the sale.
Mm-hmm.
I know it feels backwards because real estate's all about buy and sell.
Yeah.
This is about sell and then buy. Now, it's a pretty rigid process. It's not difficult, but it's rigid.
Mhm.
You've only got 45 days after your sale to identify your potential replacements.
Mhm.
You have 180 days to complete the process.
Mm.
But as long as you purchase at least as much real estate as you sold and use all of the proceeds from the sale to do that, and you've operated within those time frames and used a QI, you will get to indefinitely defer all the tax.
Hmm.
It doesn't matter what type of real estate it is,
Okay.
as long as it's used for investment. Now, that's huge for those of us who like to dabble in different sectors, or as you grow through your life cycle. You might start with single family rentals,
Mhm.
but then you might like to want to move into multifamily. At some point in time, triple net commercial properties start to seem attractive. You become a little more passive. Maybe you're starting to grow a young family, a vacation rental someplace
Mhm.
where you can generate income and start to grow the family memories. Or maybe it's retirement time and you want to have a series of vacation homes. So you get to spend the fall in the Northeast with the winter in Florida and the summers in Colorado.
Mm.
So you have vacation rentals in each place, all with all of the profit, all of the depreciation tax deferred. So any type of real estate anywhere in the country, that's
Yeah.
the 10,000-foot view.
Sure.
Yeah,
That's nice. So you can 1031 the into multiple properties, right? It doesn't have to just be one, right?
absolutely.
Hmm.
Yeah, that is what we would call a diversification
Mm.
exchange. Now, that is great for people who are starting out or who have a niche they want to stay in. They're starting out, right? We scrape enough money together, buy that first property, paid a couple $100,000 for it. We're not going to sell it for 400,000. Well, I might like to buy two $200,000 properties.
Mm.
Lets me start to spread out the risk. I'm creating generally greater NOI from two smaller properties
Mm.
than I will from one larger property. And most importantly, what we found with young investors is there's a comfort level that they'll have. If I buy a $200,000 property, I might know where to locate them, who's going to rent them, what types of fixtures and furnishings go best for that demographic. But when I'm selling that for 400,000, all of a sudden it's like, well, wait a minute. Is laminate okay? Do I need granite or corian? What type of floor? Where am I going to look? Who's going to rent? How
Mhm.
much is it going to rent for? So the 1031 exchange allows you to do exactly what you just said.
Yeah. Yeah.
Just sell that large asset, buy multiple small assets that keep you in your comfort zone.
Yeah, we've actually done it with large, because we do a lot of SFR, and we've done it with people doing large sales of, a mobile home park or something like that, and then we'll 1031 into a portfolio of single family homes. So talk to me about some of the things they need to be thinking about with the with the profit, and the existing debt as well, and how that needs to be replaced. And does it have to be every single dollar? If say they leave $20,000 on the table or something like that, they're only going to then be responsible for paying the taxes on that amount, right? Is that how that works? Or
That's correct. That would be
well,
called a partial exchange.
mm-hmm,
And you can certainly do that. And a lot of times that's really the principle of keeping your foot in between the accelerator and the brake.
mm-hmm,
Do you have a need for money in some other way? And
mm,
is it cheaper to pay the tax on that excess
yeah,
amount
yeah,
versus going and borrowing from somewhere else? In general, the reinvestment requirements are simply that if you want to defer all tax, you purchase at least as much as your net sale and you use all of the proceeds from the sale to do that. Now, like you said, you can take money out, you'll pay tax on that.
mm-hmm,
You can buy less than you sell, you'll pay tax on the difference. But
mm,
that's what you've got to do. And what we mean by net sale and net proceeds are the contract price minus closing costs and commissions.
okay,
That's your net sales price.
mm-hmm,
Then you subtract any mortgage that was on the property,
mm-hmm,
and that leaves you with your net proceeds.
mm-hmm,
That's what goes into your exchange account.
mm-hmm.
So a lot of people don't understand it, but there is no requirement to match the debt. You
Okay,
can take less debt, but you'll pay
okay,
tax on difference. You can also juggle your proceeds in between multiple purchases however you want. But as long as at the end of the day, you purchase at least as much as you sell and use all the cash, you defer all tax. Most people won't have excess cash laying around to replace a mortgage,
mm-hmm.
so they replace the mortgage.
Yeah, yeah,
It's not a technical requirement. And here's where that can become really a pretty cool tool to utilize is let's say you were selling a $500,000 property that had $200,000 mortgage on it. You need to buy 500,000 in real estate. You need to use all 300,000 of proceeds.
mm,
Right with me so far?
yeah, yeah,
What if you bought one property for $250,000 cash
okay,
and then use the other 50,000 as a 20% down payment
Mm,
on another $250,000 property.
yeah.
Did you buy 500? Yep. Did you use all of your cash? Yep. But look what else you did. You just concentrated your equity so
Mm.
that now it's much more easily available if you find another target, or if you want to keep, if you want to get access to money, but you don't want to pay tax, you complete your 1031 exchange and then do an immediate cash out refinance
Really? Okay. Mhm.
their property.
Yeah, and that was going to be one of the questions I was going to ask you was, is there any time period where you kind of have to, you can't really touch it after the 1031 has been done with the in-place debt or something like that? You mean, so you're saying you can do a cash out refi almost, start the process the next day or something like that, or?
Well, absolutely. The IRS doesn't really like you to like
That's what I've
take
heard.
money
Yep.
out of the property before you sell,
Okay.
because they tend to view that as you're taking out profit ahead of time.
Sure.
But once you have purchased that property, what you're actually doing is you're not taking out profit, you're borrowing the bank's money.
Mm,
The bank's money is secured by the equity in your property.
mm,
So the joke in our industry used to be, how long do you need to wait?
yeah.
Long enough to put one pen down from signing this purchase documents and pick the other pen up to sign the refinance documents.
Yeah.
There's really no need to wait.
Gotcha.
Now,
Nice. Okay, so let's talk about the 45-day identification period. What should you be doing before that happens? What should you be doing during it happens? Because
oh
you
gosh,
got to be prepared, right? I mean, you probably wouldn't advise somebody to just find one property, right? I mean, what's your insight there? How should people be thinking about that? And two, I'm curious to like the QI. What I don't know if they all operate the same way. Like if there's any assistance there in the understanding, and then that 45 days is that hard and fast. I just threw like 10 questions at you, but yeah, go for it.
yeah, well, I think the biggest thing is if you're not during the 45-day period, if you're not a praying person, you
Yeah.
need to become one. And if you are, then recruit a friend to help you pray.
Sure, sure.
Well, it's actually not all that bad. 45 days feels very scary
Hmm.
because it's an artificial constraint.
Mm,
But when you start to look at it, except for certain times in a market, 45 days to locate a property isn't all that bad.
hmm.
But what I tell people to do is, first of all, do the hard thing first. At any point in a market, it's going to be skewed more towards a seller's market or a buyer's market. So do the hard thing first. If the hardest thing is going to be finding the new property, then try to get that under contract even before your old property closes,
Hmm. Hmm.
because that's perfectly fine. You just have to close your sale before you take title to the new property. Tons and tons of our investors will actually get their new property, their old property, under contract for sale. And the next week, as soon as contingencies are resolved, they'll go under contract for their new property to mitigate that 45-day risk. Well, what does that effectively mean? Instead of 45 days, you've actually got 2 or 3 months.
Mm,
And that feels a whole lot easier
yeah.
to do that. But let's say the hardest thing is going to be to sell your old property. What does that mean? It's a buyer's market.
Hmm.
So take care of getting that under contract. And then guess what? There's going to be this candy store
Mm,
that you get to choose from. So the 45 days really isn't going to be that big of a deal.
hmm.
But the 45 days is fixed and rigid.
Mm.
Your list has to be in place by midnight on day 45. Had a client ask me yesterday. He said, I've heard that some QIs will let you fudge or substitute or whatever.
Yeah.
I said, I'm sure there are.
Sure.
But those of us who've been in the industry long enough,
Yeah.
we remember the one person who went to jail
Oh my
over
God.
the fraudulent 45-day list. and we're just not really willing to risk that.
Yeah, I could imagine. How does that work? Like, so how do you become a QI? Is there like, what's the requirements for it? And then is there like a annual, or I mean, what do you have to do? And then like to that point, like, who are you giving those lists to? When do you give them? All that kind of stuff. I'm curious to what the QI does.
Oh my gosh. Yeah, realtors get so mad at me when I'm teaching
I can
CE
imagine.
classes because I asked them, I said, so where'd you guys go to real estate school? Well, that's like hours, weeks of real
Yeah.
estate school. And then what do they have to do? 60 hours of post licensing,
Mm,
24 hours a year of continuing education.
yeah.
I mean, it's a big, massive education.
Yeah.
If you've ever looked at a realtor that has all that alphabet soup behind their names,
Sure.
ARDR, all that kind of stuff, well, those are all classes
Yeah.
they have to take.
Yeah.
I can't make this up, Peter. This is in the statute. You are a qualified intermediary if you are not disqualified.
What that
That's in the
so
statute.
maybe the better question is what would disqualify you? Jeez.
The only thing that disqualifies you is if you have a business or family agency relationship.
Okay.
Oh, we
Interesting.
simply have to be an unrelated third party. Now, I know that scares the bejeebers out of everybody, and because it's awfully easy to hang a shingle.
Yeah.
The reality of it is, since this statute's as old as it is, and since the results of it, the modern day version, comes from the Starker versus Commissioner
Mhm.
lawsuit. It was a 20-year lawsuit
Wow.
settled in 96 where the IRS lost. The only people generally who dare to tread in this kind of nerddom
Mm.
are accountants and attorneys like myself. And we call it going 2 miles deep in a 2 foot wide creek. I'm an accountant, but I don't do taxes. I'm not going to do bookkeeping.
Mhm.
I can only do your 1031 exchanges.
Mm.
My attorneys cannot practice law for you. We only do the 1031 exchanges. So we're very deep in that. So generally, when you're dealing with a large or a national QI firm,
Mhm.
you're dealing with decades of experience.
Mhm.
It's just that statute.
Mm.
So there is a trust factor there that's there because
Sure.
we have to be your guide
Yeah.
through what I call the Mines of Moria,
Mm.
which is the IRS statutes. We have to get you through that.
Yeah.
So it's very easy to call yourself a QI. It's not so easy to really be one
Mm.
effectively.
Mm. Interesting. So okay, we talked about the 40 days. Talk about the 180. So now that you have to identify everything, it's 45 days, right? Is that correct? 45.
Correct.
Okay. 45. And then so now everything's identified, then you have 180 days to close. So a lot needs to happen in that time period. And maybe certain deals might work better than others, too, to get that done, like a land development play or something like that, where unless it really makes sense and it's a piece of ground you want to close on, if you got to go through all the entitlement and everything else, it might not be the best thing to do. So talk
Right.
to me about what you're doing in that period of time, and the importance of getting that to the closing in that 180 days.
That's actually a great question because that really takes us into the transitional nature
Okay. And that
of
was
the
that was in the back
process
of my
of this
mind, yeah,
deal.
because we were talking about that, the
Yeah.
transitional strategies.
Typically, as people are going through their progress, generally people don't start out with a big land purchase
Hmm.
or a large industrial property purchase. They're going to start with, like you, single family homes, and
Hmm.
that's where we cut our teeth. The due diligence periods, just think about that for a second,
Yeah.
are so different.
Yeah.
If I'm buying a little house,
No environmental and
days,
yeah,
we're
exactly.
done.
Yeah.
But yeah, commercial or a piece of raw land, things. By the way, that's the only time I ever really thought I was going down was when I bought a large tract of land,
Okay.
started to do my phase one environmental,
Yeah.
and it came up clean.
Okay.
So I bought it.
Yeah.
Well, now you think you're on easy street then, right?
Yeah. Yeah.
So the excavators for the first road uncovered a pioneer grave.
Oh God. Oh my God. Really?
Yeah, no kidding,
Wow.
right?
Yeah.
We were worried because the site had been an Indian campground
Wow.
on the Oregon Trail.
Wow.
that you know what happens if you find an Indian grave, you're done. That
I
land
can imagine. Yeah.
under the trial. Fortunately, when by the way, this is all just a fun story.
Sure.
But when the state archaeologist came out to examine it, he looked at it for 5 seconds and he said, "Take it easy, you're fine." How in the world can you say that?
Yeah,
There's a
exactly.
body on my land. He said, "Look at these little marks. They're
Mm,
dark spots that outline the body."
mm,
He said, "That's what's left of the coffin nails." And Indians did not bury their folks
mm.
inside coffins.
Wow.
So they
Interesting.
dig the remains up. There's a secret place in every state where they bury the unknown
Mm,
deceased.
yeah.
And we were able to go about our thing. But what's this all illustrate?
Yeah.
The fact that you could use those due diligence times to your advantage.
Mm,
Remember that 45 days is simply to identify.
mm,
Go under contract for that thing way before the 45 days starts.
mm,
Plan it so that your due diligence will end during the 45-day period.
okay. Yeah.
So you've always got your outs
Yeah.
that you need to have. That's how that transitional, when you're going to go from single family to commercial, can be used to work together for you. The same thing is true. We didn't really talk about this specifically, but 180 days can really be used for new construction really well.
Okay.
You go into contract, it may take a year for a property to get built, but you really want to own new construction. Why? Less capital expense, maybe incentives for the builder, growing areas, whatever the reason is.
Yeah.
But you go into contract to buy that property a year before it's built.
Yeah.
The builder owns the lot, they're building it for you. Will you wait to sell your old property till you're 7 months into the process?
Mm,
So that your 180 days starts within 3 months of when that new property is supposed to be ready.
mm,
So did you know what property you were going to buy? Yeah, you knew for a year,
yeah.
but it was under your control.
Mm,
But you didn't have to worry about anything until you sold your old property. Now, the only thing I caution people on is if the builder tells you it's going to be ready in December, put February on your calendar because they
yeah.
have no concept of time.
Yeah. That's funny. Is there, so we talked about, is there any real estate asset that you just would advise against? Like if you saw somebody, pull that up, in their 45-day identification period, that you would say, probably not the best, or could it really work for any, I mean, for certain people, in almost any asset class?
Yeah, I mean, I think that's probably it. It's because it really comes down to what the individual strengths are.
Yeah. Yeah.
Uh, I have people, I mean, it gives me heart palpitations all the time, but they'll go buy stuff at auction,
Mm-hmm.
but they're so comfortable doing it,
Mm-hmm.
they don't worry about it.
Mm-hmm.
Or people that will buy stuff, get into contract on it, what's it tangled up in probate
Yeah.
or trust or lawsuit resolution. Well, that scares me to death.
Yeah.
But they live there, so they're comfortable doing it.
Yeah.
So I think it's all about where the market is and where the strengths of the individual are
Yeah.
in
Yeah.
terms of what asset class is going to work. But that's the beauty of the 1031 is that
Yeah.
any asset class will count. As a matter of fact, there are certain classes of real estate that you wouldn't normally think are real estate that
Mm,
qualify for the 1031.
okay.
Did you know that you could sell a duplex in Cincinnati and go buy an oil well in Texas
No.
using
Mm,
1031? Mineral rights, oil rights, and resources
yeah.
are 1031. Now, what's beautiful about that? We have clients that ride the contra cycle.
Mm-hmm.
As real estate goes up,
Mm,
typically energy is cheap.
mm-hmm.
As energy starts to rise, construction prices go up.
Mm-hmm.
What's real estate start to do? Stagnate and then retreat.
Mm-hmm.
So when real estate reaches that high, they will jump from highly appreciated real estate into less expensive, oil and natural gas projects.
Interesting. Yeah.
And they'll ride that up. It's all about the cycle. Different states will have certain things. In the Northwest, timber rights,
Mm.
can be air rights,
Yeah.
easement,
Okay. Sure.
billboards.
Wow. Yeah.
Here's a riddle for you. I raised my children on a 53-foot sailboat, Peter. For a number of those years, I lived with them on our boat
Mm.
on a property that my client had 1031 into.
Mm.
What kind of property was it?
What kind of property was it? Ah. What am I looking for? Like the exact name of like the of how that qualifies, or
Yeah, just a type. Where are you going to put a boat?
yeah,
Is there going
it's
to
on
go
the
on dry
water.
land?
Yeah.
We actually heat exchanged in Key West from a pharmacy building
Mm-hmm.
into a boat slip.
Hmm. Wow.
But the boat slip was deeded.
Okay.
So it had a property address.
Okay. Mm.
So the dirt under the water
Ah.
simply parked our boat
Yeah.
in the boat slip and rented it from him.
Wow.
So he was a real estate landlord, although his land was water. That qualified for
That's
1031.
wild.
Hey, do you know what we called that kind of real estate?
Mm.
A docminium.
I love that. Yeah, is that a real term, or did you make that up yourself? I've never heard that before. Dog medium.
I don't want to take credit for it, but maybe I did. You know, there's another one though they're very similar. Speaking of alternative types of real estate, and that would be down here in Florida and South Carolina. In particular, there's these huge Butler metal buildings that are built on the water, designed to hold boats.
Okay.
And so you own a boat, and they take a big forklift whenever you're ready to go out. They slide it into your boat, lift it up, put it in the water. You go off and enjoy your day.
Mm-hmm.
But you own that little section in the building because it's deeded to you,
Mm. Wow.
just like a condominium.
Mm-hmm.
And we would call that a rackminium. Qualifies for 1031 treatment
Wow.
as long
Interesting.
as you're using it for investment purposes.
Okay. Okay. Well, that's another question you probably get a lot is you can't 1031 your primary residence, or is there any
Correct.
workarounds, or
Well, you really don't want to because the primary residence rules are so much better.
okay.
If you live in
Yeah,
that
that makes
primary
sense. Yeah.
residence for 2 years and you're married,
Yeah.
the first $500,000 of profit
Mm.
is tax free.
Yeah. Yeah.
And you do that every 2 years. But speaking of workarounds, what if your primary resident had more than $500,000 in profit?
Okay.
Well, you could move out and go rent something else or go live in another one of your houses. The rules to get the primary residence exemption are that you have lived in the property for 2 out of the 5 years prior to selling it.
Wow. Okay.
The rules for doing a 1031 exchange are that you are using it for investment
Mm.
when it is sold. So you move out of that house, you rent it,
Mm-hmm.
turn it into a corporate event center for your business, whatever
Mm.
is comfortable for you. But now it's investment property, isn't it?
Mm.
And a year
Wow.
later, you sell that property. Now, did you live in that property for 2 out of the last 5? Yes. So the first $500,000 of profit, tax free.
Wow.
You also do a 1031 exchange on the property.
Mm-hmm.
And the rest of the profit and all of the depreciation is indefinitely deferred.
Wow. That's
So you turn a potential tax bill on your primary residence
yeah.
into tax free and tax deferred.
Yeah.
And guess what? You can also do the reverse.
Mm.
As you start to get into life cycle, so it's time to think about retirement. You're in Cincinnati. I don't know why I'm picking on Cincinnati today. But you're in Cincinnati. It's because they got snow. You're in Cincinnati. You've been there a bunch of years. You know you want to retire in Scottsdale, Arizona.
Okay.
So a few years ahead of time, you start to 1031 your portfolio from Cincinnati to Scottsdale. So When you're ready to retire, you sell your Cincinnati house tax free,
Mm,
and then you move to Arizona, and your portfolio awaits you right there.
mm-hmm,
So you got everything you need. But that's not really all that sweet
mm,
because then you got to spend money to buy a new house.
mm.
But if instead you converted one of your investment assets with deferred tax into your new primary retirement house,
Mm.
then once you've lived in it long enough, you start to convert some of the deferred tax into tax free.
Yeah,
I
interesting.
have a realtor client on St. Pete Beach that did a 1031 and bought three identical condos, beachfront, side by side, literally. When he was ready to retire, he moved into the first one and converted it into his primary residence.
Okay.
He then lived in it for 3 years. So he rented it for 2 years,
You can see where this is going.
three.
Yeah.
Then he sold it.
Okay.
He got to take 3/5 of the profit tax free.
Wow.
That had all been tax deferred up to that point.
Mm-hmm.
He did have to pay recapture of his depreciation. But still, as a retirement job, I mean, dude, if you're going to go work at Domino's
Mm.
or bag groceries,
Yeah.
you're going to get a W 2 in taxes anyways.
Yeah.
His job was sitting on his back deck, sipping coffee.
Yeah.
Well, what's even more awesome, Peter, where did he move?
Assuming right next door.
It started the
It's
process.
yeah, it did it all over again. Yeah. Wow.
What a retirement concept.
Yeah. Unbelievable.
Yeah, there's a few workarounds.
Well, let's continue the conversation around these transitional strategies. One question as a fund manager, one question I get all the time is, yeah, can I 1031 my, properties into an LLC? I mean, into a fund type of structure. And typically, the answer is no, right? But is there any kind of workarounds there, or with Delaware Statutory Trust and all?
Right.
Like, what can you do with that?
Now, yeah, DSTs are a little bit of a different animal because they have been specifically blessed by the IRS for
Mhm.
1031 exchanges.
Okay.
So they become, taking us all the way back to the 45-day period, they can become a great hedge if you're having trouble finding a new property
Hmm.
because DSTs are typically readily available. So you may want to buy an apartment building in Omaha, but you just can't find one. So at the last minute, rather than pay the tax,
Hmm.
you put it into a DST. You get cash flow on the cash that goes in. You still get all of the amortization of the loan, which is non-recourse to you.
Yeah.
You get the appreciation of the property. You get continued depreciation of the property.
Mm.
So they can be a real win-win-win
Hmm.
in terms of that. The type of thing you're talking about, a lot of people will also know by the name of a syndication,
Sure. Hmm.
right?
Yeah.
Where you create a general partnership and you bring on limited partners to that. Well, you cannot 1031 into that structure specifically because you're not buying real estate.
Hmm.
You're buying an interest in an entity
Hmm.
that owns real estate.
Yeah.
There are a few of them out there, and they had to spend a lot of money to do it. There are a few out there that can take you on as a tenant in common. So
Mm.
instead of buying an interest in the entity, you're actually buying a percent of the real estate itself.
Interesting.
And that qualifies.
Wow.
You know, the few that can do that typically have some pretty high minimums,
Hmm.
500 or $1 billion
Yeah.
minimum to get in. But that's one hack for it. The other hack for it, and my favorite one, because I have clients doing this all the time, goes back to what we talked about earlier about the cash out refinance.
Hmm.
Remember that $500,000 property that I
Yeah.
sold?
Yeah.
Bought the two $250,000 properties?
Yeah.
Well, that one that is free and clear,
Yeah.
why don't I refinance it immediately
Hmm.
and then use that money to invest in the syndication.
Yeah. Wow. That's unbelievable. That's powerful. What are some other things I haven't asked you? I mean, or some other some other strategies that maybe I've never even thought of. Because I feel like this is such a there's so it takes. How long was it in this business? Maybe before we get into that, I'm curious. Before you felt like you really understood the power of it, and maybe even today you're still learning things. I don't know. You know what I mean? But I would think it takes time, right? And I think I would hope people need to understand that, right? This isn't something you're going to get, overnight or with one book or something like that, right?
Yeah, it's I like to describe it in this way. The statute itself is like two sentences,
Okay.
but there's about 10,000 pages of case law.
Wow.
So a lot of it is digging through, and you've got to balance the old with the new, right?
Okay.
Precedent with new law.
Mm,
Because as you've seen, anybody with familiar with 1031s knows that seemingly every administration
mm,
wants to tinker with it. They
sure.
want to get rid of it. They want to limit it this way. They want to do this. Well, you've got to balance that against your knowledge of case precedent
Wow.
and then start to look at the opportunities. So I think where I have got my biggest benefit in understanding 1031 is the fact that I am a decreed accountant.
Mhm,
So I understand the accounting side of things,
mm,
but also the reason why I became an accountant was not to do someone's taxes.
mm,
I became an accountant because I saw that as the best adjunct
mm,
for me to be the best real estate investor I could be.
mm,
Because the opportunities within real estate investing to advantage yourself tax wise
mm, sure.
are so huge.
Yeah.
So my informal education, coupled with the boots on the ground,
Yeah.
living my own life and doing it, kind of brought me here today. And these are the things I'm describing for you are all things I've done.
Mm,
And they've helped me to lead clients to do.
yeah. Yeah.
So it's not just theory from a classroom.
Yeah.
And so I've enjoyed that. I like to talk about the 4 Ds of 1031 investing.
Okay. Tell me, it is funny because I've seen you talk about it before and I was going to ask you about it. Let's
Yeah.
talk about that. What are they?
So it all starts out with the first D, which is defer. And what we're talking about with that is compounding interest.
Mm,
Start it by selling a property and taking, in my case, take that $30,000 and go buy more real estate instead of paying the tax.
yeah.
As long as that $30,000 stays with you, you get the benefit. Now, whether that's 2 years or whether it's 30 years, it's benefiting you. You're getting the profit off of the government's dollars.
Mhm,
The second D is also defer because the 1031 will let you to will allow you to continue deferring that tax no matter what the real estate market is telling you.
mm,
So if you invested in California in 2012 when things were depressed, relatively speaking, you got to ride that wave of astronomic appreciation.
mm.
But at some point in time, do you remember what all those folks in San Francisco did? They sold their Bay Area properties, and they went and bought cheap properties, dirt cheap properties, in the sleepy little town of Austin, Texas,
Mm, yeah.
where a guy named Elon Musk was starting to build a couple factories.
Mm.
What's happened to Austin since?
Phew, yeah.
So they sold high, they bought low because they could use the 1031 exchange to transition locations.
Mm,
They could use the 1031 exchange to transition sectors.
mm,
Is commercial an attractive opportunity now? Sell your single family, go buy commercial.
mhm.
Everybody was trying to move from single family into large multifamily for a long time.
Sure.
Hard to find those deals now,
Yeah. Yeah.
but there's some great deals starting to come up in retail,
Sure.
farmland, whatever it is, the 1031 can accommodate that. What do you think the third D is?
I'm gonna guess defer.
That's only because you already looked ahead. Yeah, you're absolutely right. Just like you could use the 1031 exchange to accommodate whatever the real estate market is telling you, you could use it to accommodate whatever your personal life cycle is telling you. Are you starting out and you've got more energy than you have brains and money?
Mm.
Go buy a beat up single family, grab a hammer, grab a bottle of scotch for the electrical problems, and just make it happen.
Yeah.
But at some point in time, this transition happens, doesn't it?
Yeah.
And all of a sudden we realize, well, wow, wait a minute. I've really got not a lot of time,
Mm-hmm.
but I've started to accumulate money.
Yeah.
So use the 1031 exchange to do things like start to consolidate, sell several properties that are time intensive, go buy one larger property that you can operate more passively.
Mm.
Start to move from active investing into more passive investing, whether that's a fund that will accept 1031s or DSTs or triple net commercial properties or things you invest in as a junior partner
Mm-hmm.
or where you own the real estate. All of those type of, are you starting a family? We talked about the idea of buying that vacation rental.
Yeah.
So you still get all of the tax benefits. By the way, vacation rentals are one of the few real estate assets that an accredited investor can buy that are not treated as passive income.
Mm.
So you have the opportunity of being able to take accelerated and cost segregation
Yeah.
for your depreciation, the opportunity to write off other things. So vacation rentals at a certain point in your life cycle can really be huge.
Sure.
Plus, who doesn't want to own the condo in Winter Park that you go ski at every year?
Yeah.
Why not? So accommodating retirement. Move your properties to the location you want to retire. Start to do some of those conversions. All of those accommodate where you're at personally.
Mm.
All right, the fourth D, and I'm not going to trick you because nobody thinks of this, but the fourth D is die.
Mm.
What? Defer, 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 and then die.
Mm-hmm.
But it's so important for that final linchpin of
Sure.
your strategy.
Yeah.
Because when you pass away, your real estate assets go to your heirs at a stepped up basis.
Mm.
They get it tax free. You
Yeah.
don't pay the tax. Your estate doesn't pay the tax.
Wow.
Your heirs don't pay the tax.
Yeah.
The tax disappears. We've actually got one family in Greenwich, Connecticut. We're on their third generation of
Wow.
never paid a penny.
Wow. So you restart that 4D cycle there.
That's exactly what they did. We weren't doing the
That's
1031s
amazing.
with
Yeah.
Grandpa.
Wow.
When Grandpa died,
Mm.
the properties all went to his son, tax free.
Yeah.
So we didn't hear from the son for a few years.
Mm.
But then all of a sudden, he was back knocking on the door
Mm.
because now he had properties with profit
Mm.
and he needed to sell it to 31. So we worked with him for a bunch of years.
Mm.
He passed away not too long ago. His properties went to his children,
Mm.
tax free.
Wow.
And now they have just started to come back again to us. And we're starting to do things again. That's 3 generations without paying a penny to the government.
Wow.
In tax on real estate. I mean, I do it for myself, so I love it.
Mm.
But it just seems like to me that between the primary residence exception and the 1031 exchange, those are the 2 greatest real estate acts that the IRS has given to us.
Mm-hmm. Yeah. Ah, that's amazing. I feel like that's such a great way to put a bow on the episode. And the 50 is Dave's, right? So you need you need to talk to Dave.
I like that.
Add it in there. Right? The how can people get in touch with the Dave? How can they learn more, get into your world, and how can they?
First of all, now I got to give you credit every time I say that. That's awesome. So We've made it very easy because the one thing we learned early on in the early 2000s was nobody knows this.
Sure.
So education is key.
Mm,
So we've developed our entire presence around education.
mm.
The 1031investor.com has a 60 sub part YouTube channel.
Wow.
We have calculators to help you out, access to our consultants directly.
Nice.
I wrote a book called Lifetime Tax Free Wealth,
Mm.
a real estate investor's guide to the 1031 exchange. And I did not write it as a step one, step two, here's what you do. I wrote it as a series of case studies
Mm.
on people who have actually used it, because that's where the fun is.
Sure.
Let's apply it.
Yeah.
But the1031investor.com, that's where you can find us and learn about how to defer death, and then contact Dave.
Love it. Well, Dave, thank you so much. This has been a blast. You made 1031s fun, which I don't know if that's always, it's fun. Saving the taxes is fun, but learning about it, all that kind of stuff, you really have a great way of doing it and telling the stories along the way. So really appreciate you being here. Thank you so much.
Enjoyed it. Thanks.